Muted.
Good afternoon. We probably will have some others joining us on the webinar, but this is Kathy Graham, Director of Benefit Services for the Employers Association. I want to welcome you to our webinar on the new HR option for small employers. This is an exciting new benefit, I think. I got very excited about it when it first came out. It is something that will help small employers be able to offer their employees some assistance in healthcare purchasing or paying for some medical medical expenses. So I'm going to turn it over to Brenna Davenport with Pointer Sproul here in Charlotte. We will be asking questions at the end of the or answering questions at the end of the presentation. Thank you, Brenna.
Good afternoon. As Kathy said, my name is Brenna Davenport. I'm an attorney with Pointer Sproul, a full-service law firm in Uptown Charlotte and across North Carolina. And I'm so thankful to be here today. This is one of my favorite things to do, to help small employers navigate the complex world of ERISA compliance. And I do agree that the new HRA option for small employers is an exciting new thing that small employers are definitely going to investigate. So today, in particular, we're going to be talking about why we need this HRA. It has to do with some of the constraints that came under the Affordable Care Act. We're going to talk about the 21st Century Cures Act, which actually created the QSERA, which is what we're talking about today. And just so you know, QSERA stands for Qualified Small Employer Health Reimbursement Arrangement. That is a mouthful, hence QSERA. We're going to talk about all of the requirements related to the QSERA arrangement so you can assess whether this is a good option for you or not. And also the other laws affecting the QSERA. Not a lot of people know about the fact that the QSERA does have some notice requirements associated with it, so we're going to talk about that a little bit. And we're going to touch briefly on the other relief that the 21st Century Cures Act provided related to this issue. And then, we're going to touch very briefly on how the Trump administration may affect the QSERA. Emphasis on may because, who knows what's going on or what will happen at this point. So why we need the QSERA? As I said, it's because of the certain constraints that were imposed by the Affordable Care Act. So one of the first ones was that the Affordable Care Act prohibits annual and lifetime limitations on essential health benefits. This is a great thing for the consumer because we don't want those limitations on our essential health benefits, but it made it where you couldn't have a standalone HRA plan because by its nature an HRA has a cap on the benefit on an annual basis. The Affordable Care Act also came along and prohibited reimbursing employees for coverage obtained through the individual health insurance market. And it also prohibits cost sharing regarding preventative services. And these are things you don't want to mess with because the penalty associated with not complying with these is $100 per day per person, so per participant affected. So that can really add up quick. So the effect of these was that a lot of small employers pre-ACA were offering reimbursements for individual health coverage that their employees obtained in the market. Or they had some kind of standalone HRA arrangement. But these could no longer be pursued under the ACA with some very limited exceptions, which we'll touch on briefly later. But now, realizing that this was an unfortunate unintended consequence, Congress came along and created the 21st Century Cure Act. which was enacted December 13th, 2016. It was actually geared towards enabling clinical trials and enforcing the Mental Health Parity Act, but as part of it, they created the QSARA, which is effective for plan years beginning on or after December 31st, 2016. So this QSARA basically looks like the old premium reimbursement plan or even an HRA plan that small employers used to provide pre-ACA. But there are, of course, special rules that come along to kind of tie in with the ACA, and we're going to talk about that next. So there are two key concepts to think about with the QSARA. So it can only be offered by an eligible employer to all eligible employees on the same terms. So we're going to break down what eligible employer and eligible employee means first, and then I'll touch briefly on some caveats to that same terms concept. So eligible employer, that is defined as someone or an entity that is not an applicable large employer. So this concept of applicable large employer is defined under the employer mandate. So if you don't have to worry about that, you can have a QSARA, so long as you do not offer another group health plan to any of your employees. So one, it kind of seems obvious what is a group health plan, but it's actually not something that's defined under the rules. So a lot of questions that I get is, well, we offer something like a skinny plan, which has very limited, maybe preventative care coverage or cover generic drugs, but nothing else. Can we have that on the side with our QSARA? No, you can't. That's another group health plan. Where it gets a little unclear is, well, what about an FSA? What about, we have a dental plan, we have a vision plan that's standalone on the side. There's actually no guidance as to what they mean as to no other group health plan. And so in a conservative read of the rules would say that, you can't have dental, you can't have vision. So we're hoping that the government will come out and give a little bit more guidance about what that is supposed to mean. But some initial thoughts is that, a standalone vision or dental would probably work. You just have to know you're entering into the world of risk if you do that. So eligible employees. So this includes any employee of the eligible employer, but you have the option to exclude employees who have not completed 90 days of service, employees who have not attained age 25, part-time and seasonal employees. And just so you know, there's a little safe harbor rule that helps you define what part-time and seasonal means. That is any employee whose customary employment is less than 25 hours a week. So that's going to be part-time. And then less than 7 months a year is generally considered a seasonal for purposes of this rule. You can also exclude collectively bargained employees and then non-resident aliens without U.S.-based income. Employee is not a defined term under this rule, but you can assume it means common law employee. So where a little hiccup comes in, though, is when you're dealing with leased employees, self-employed persons, former employees, and retirees. Under the common law rules, none of those 4 categories of people, leased, self-employed, former, and retirees, would be eligible. We're hopeful that they'll come out with some guidance covering self-employed persons, because think about your S-Corps and all that kind of arrangement that is common to small employers. It'd be helpful for the owners to be able to participate in this kind of arrangement. And then just so you know, it's not only open to employees, but these eligible employees' family members. Again, family is not defined under the rules, but you know, it's intended to cover spouses, tax dependents, children who have not attained age 27. And then just to touch briefly on this concept of same terms, there is one small exception that you could pursue. So this allows you to make variations in how much you're going to offer for different people at the same time, and it has to match the variations under a chosen insurance policy in the individual market. So what that means is that if older individuals are being charged, for example, 3 times more in premiums than their younger counterparts, you could offer 3 times more benefits on the QSARA for the older individuals than you do the younger, subject to the caps that we're going to talk about now. So this is going to be the slide where I talk about the caps, but the first concept that we want to talk about is that the QSARA can be funded solely from the eligible employer's contributions, which means there can be no salary reductions as part of this plan. And it's 100% on the employer. One question comes up is, well, could we allow for payment of like premium costs for that individual coverage in excess of the QSARA limits? So long as that is structured on an after-tax basis and is a purely voluntary benefit, the thought is that you could do that, just in case somebody's got a voluntary, has individual coverage that exceeds the limitations of the QSARA. And then one of the elements, or one of the conditions for the employee to participate in the QSARA is they're going to have to provide proof of coverage that is providing minimum essential coverage. So in order to enroll, they're going to have to present to you like an insurance certificate saying they have insurance coverage. Otherwise, they can't participate. And if at any point their coverage lapses, you really shouldn't be making any further reimbursements under the plan. And if it does happen, it's going to be, they need to refund it to you, or it's going to be a taxable matter for the recipient of that reimbursement. So here's the caps. So for this year, the reimbursements cannot exceed $4,950 for individual coverage. $10,000 is allowed for family coverage. One little special rule about this is that it has to be on a pro rata basis based on the full year. So, if you have a mid-year hire or you start your plan mid-year, these participants are only going to get a $412.50 benefit per month. If it's an individual coverage, $833.33 for a family coverage. So if they come in the middle of the year, you start your plan mid-year, it's going to be, they can only have benefits to the extent of half of those amounts listed there. So one of the final requirements is that, just like a regular HRA, you can only reimburse something called qualified and substantiated medical expenses. What is a qualified medical expense is defined by the Internal Revenue Code. One fun thing is it does include premiums paid for minimum essential coverage. So this is where you're able to reimburse employees for the premiums they expend to obtain individual coverage. The other thing to think about is that when they submit a claim for reimbursement, it has to be substantiated. So they can't just say they had this expense, please reimburse me. They got to, present the bill and maybe the EOB showing what was not reimbursed by coverage otherwise. One question I get a lot is, can the employer restrict the eligible expenses under a QSARA? And yes, you can. So, if you didn't want to reimburse for every qualified medical expense, let's say you just wanted to reimburse for premiums, period, you have the leeway to do that. So there are other laws that the QSARA needs to comply with. So, that's how employee benefits are. You can't just worry about one law. You have to worry about a lot of them. So the first one is under the Internal Revenue Code. A QSARA is actually not considered a group health plan under the Internal Revenue Code, and this is what makes it exempt from a lot of the ACA requirements, with the exception of the Cadillac tax. But to be honest, I wouldn't really worry about that, because the Cadillac tax, well, has been pushed off, and it might go away. But in addition to that, the Cadillac tax levels, when that comes in where you have to be concerned, are way above the limits of a QSARA. And so the other fun thing about the QSARA not being a group health plan under the Internal Revenue Code is that this plan is not subject to COBRA. I say that with the caveat that it's always important to look at the state law requirements as to continuation of coverage. I think it's reasonable to say that, it's not a group health plan under the Internal Revenue Code, so, it's under that COBRA rule, so it shouldn't be under the state COBRA rules, but this is something to just look out for as people start to use the QSARA more. So another thing about the QSARA is that the cost of coverage is included for purposes of W-2 reporting, and what you're going to report is the actual amount of the permitted benefit. So if you decide that you're going to allow $4,950 permitted benefit annually for individual coverage, and that person enrolls on that basis, you're going to report on that W-2 $4,950. So the QSARA, it's kind of fun, or I think it's fun. The congressional minutes about implementing the QSARA goes to great lengths to say, yes, it's subject to HIPAA, yes, it's subject to HIPAA. But the fun thing is that there is an exception to having to comply with the privacy and security rules for small group health plans, such as what we're talking about here, so long as they are administered by the employer, not a third party. So as long as you're administering them yourself, and you have fewer than 50 participants, which you are by the definition of a QSARA, you technically don't have to worry about HIPAA. But you just kind of want to make sure that your plan probably has an addendum with all the HIPAA language that automatically triggers when you do get a third-party administrator. So you don't have to worry about it. So under ERISA, the QSARA is not a group health plan, but it is a welfare benefit plan, and from my experience, this is something that is often surprising to employers. Well, it's not a group health plan. Don't I have to not worry about ERISA? Unfortunately, ERISA does apply, at least unfortunately from the administrative side. But it's not so hard. You have to worry about the SVD, and other general requirements of ERISA, but since the plan is so small and it's a welfare benefit plan, you do not have to worry about 5500 reporting. So let's talk about the QSARA notice requirements, because this is something you're definitely wanting to think about if you decide to implement this kind of plan. You know, the IRS did come out and say, yeah, we realized we didn't give you a lot of guidance, so we're going to postpone enforcement of your having to provide the notice until we give you more guidance. And that's really nice and very helpful. But once you see what is required in the notice, I think you'll see why I recommend that you give the notice regardless. So when do you have to give it? It has to be provided at least 90 days before the beginning of the plan year. So while we're in this postponement of additional guidance, you technically could implement the plan and just give, for example, 30 days advance notice, and you'll still be okay. But once we get that additional guidance, you're going to have to give 90 days advance warning. As to new hires, you simply have to give it before the employee first becomes eligible to participate in the QSARA. So what does this notice have to communicate? So first of all, it has to communicate the amount of the permitted benefit. So if you decide to go all out and do 4,950 individual, 10,000 family, you have to communicate that. You also have to tell the employee that they should provide this information to any health insurance exchange to which the employee applies for advance payment of premium assistance tax credits. Okay, and this is the main reason why I say please give the notice. Excuse me. Because we'll talk about this in the next slide. Offering this benefit does affect these employees' eligibility for tax credits for the subsidies that they could otherwise obtain from the health insurance exchange. And unless you tell them this, they're not going to naturally know that. And once they file taxes, they could get in a lot of trouble having to pay back the credits that they've received, and it just would be a headache. That's easily avoidable. And then the last thing you have to communicate is that if the employee is not covered under minimum essential coverage for any month, the employee could be subject to the individual mandate. I mean, they should know that already, but there it is. I think the point is to clarify that QSARA is not going to satisfy that MEC requirement alone. And then also communicate that reimbursements under the QSARA would be included in gross income should their MEC lapse. And so just so you know, this is something to watch out about when they provide the additional guidance, but just so you know, the penalty for failing to provide the appropriate guidance is $50 per participant, basically, up to a $2,500 cap per year. So not a whole lot of money, but still, it's avoidable. Let's avoid it. So I mentioned on the last slide that offering this benefit does affect your employees' eligibility for premium subsidies from the health insurance marketplace. And just to help you understand how this works, we're going to walk through a little example. So it's actually going to reduce the amount of their subsidy. How much you offer is directly and proportionately going to reduce how much subsidy they can get. So here we have, let's just assume we have an employee with household income of $2,500 per month. So that means they make $30,000 a year. So, subsidies go up to 400% of the federal poverty level, and this $30,000 is below that 400%. So based on their income, assuming an individual, they are eligible for subsidies until you come in with the QSARA. So how this works is that, you know, they come in and they say, okay, what does the cost of the second lowest cost silver plan, what is that based on your region? You know, I looked it up, and kind of in the Mecklenburg County area, that's about $350 a month. So $350 a month is 14% of that individual's monthly household income, which means it's above the 9.5% cap, meaning they could get subsidies. But then you come in and you think, oh, okay, well, they've got a QSARA benefit from the employer. So actually, their QSARA benefit is higher or more generous than the determination that the government's going to look at. So once you do 350 minus 412, that's, you know, less than zero. So now this person is actually having to pay premiums of 0% of household income. So the effect of offering the QSARA to this person is that they cannot get premium subsidies, which is fine. It's just something for the employer to think about. Look at the employee demographics. So this is going to be particularly helpful to employers who have employees with income in excess of what the premium subsidies would allow. So, you know, 500% of the federal poverty level. For those employers, which is probably going to be more common, where you have somebody who would be premium eligible for subsidies otherwise, you have to think about, well, you know, how are my employees going to respond to this? Are they going to be happy about looking to the employer for this benefit? Or are they going to be unhappy because they'd rather get the tax credit? But, you know, regardless, this is something that an employer could use as a benefit to kind of compete in the market. Say, hey, you know, we're taking care of you. You don't have to get subsidies. We'll cover you. So you just kind of have to think about the message you want to send and the demographics of your actual employees. So there was other relief that was granted in association with the QSARA. So way back when, there was a IRS notice that provided penalty relief for small employers who were pursuing these standalone HRAs or premium reimbursement arrangements. And this penalty relief, remember that was $100 a day kind of penalty, extended through July 1st, 2015. Well, the 21st Century Cures Act came out and said, we realize a lot of employers are still doing this premium reimbursement thing, so we're going to extend that penalty relief through December 31st, 2016. You know, you're not going to have to file the IRS Form 8928 and report that $100 per day penalty. You're good. And so the other side of this coin is that if you are a small employer who is doing this right now and don't have a QSARA, you need to get one. You need to put one in place, because notice that relief only extended through December 31st, 2016, meaning that if you're continuing this practice now and don't have the QSARA, you're in trouble and need to fix it, with the exception of S-Corp. And this is very narrow. So if you are doing a premium reimbursement for, and you're dealing with an S-Corp and you're only reimbursing for shareholders who own at least 2% of S-Corp, you can do that pending further guidance, and we have no clue when or if they are going to provide that other guidance. But notice this is very limited. S-Corp, 2% above shareholders. So any other employees participating in reimbursement, you're going to need a QSARA. So I don't know if y'all have seen the papers today, but some of the papers I've seen are talking about how we're going to make another stab at this repeal and replace, maybe even tomorrow. They have a new bill in place that they're considering to repeal and replace the ACA, and everybody's wondering whether it's going to pass or not. Nobody really has a clue. I will say that, one of the key aspects of this new bill is that they want to allow states to opt out of certain rules. One of the biggest ones would be allowing states to allow their insurers to charge more for pre-existing conditions. So, if that goes through, for certain people, the cost of insurance is going to go up. So this is another way for you to look at the demographics of your workforce and say, are these people generally sick? They're really going to need help. So we need to offer this. And then, but who knows what's going to happen. Because as you can imagine, just that one little component is very controversial in this bill. Another thing I've been seeing in the bills is this concept of, instead of the premium subsidies being based on income, it's going to be based on age. So, depending on if something like that comes through, you would look at the demographics of your workforce and see whether, really are they going to be affected by this QSARA and their premium subsidies under the new regime. But the point is that nothing is going to make it where, well, I haven't seen anything yet that would make the QSARA obsolete. It's certainly still a great option for small employers who are wanting to provide some kind of health insurance benefit for their employees. So with that, we'll open it up for questions.
At this time, we are now open for questions. Please feel free to just go ahead and speak, and we'll take them in the order that they come in.
Yes, hi, this is Hannah Butters from Greater Susquehanna Valley. I have a question. If the employee is not the primary holder of the insurance, are they still qualified? Are they still ineligible to receive this? Like, for example, my husband's the primary on our insurance, but I'm obviously the employee. Does that still qualify us? Could we still take the family benefit?
Yeah, so, yes, as long as the individual seeking the QSARA coverage has some kind of insurance coverage otherwise, that's
She's
fine.
saying that if he's buying family coverage under his employer, can they reimburse them for that?
Yeah,
Yes. Okay.
that'll work. It's just that the employer offering the QSARA can't offer that kind of plan.
Any other questions? Anyone else have a question? Okay, well, feel free to email Brenda any questions that you might have afterwards. A copy of the presentation will be available at a later date, but if you'd like a copy of it before then, just email me. It is graham@employersassoc.com. And with that, we'll conclude this session. Thank you very much for attending.
Thank you.